So you guys are venture capital funds which take money from large family offices, sovereign funds, Ps, different kind of people generally outside of India bring the money into India. What kind of a return are you forecasting for them when you take the money?
They all are in public markets through various other, funds. And they have been investing in asset classes like real estate and some of these others again over the vintage. I think venture is new for a lot of them. So they have seen venture in China, they've seen venture in the US. I think India is still experimental or has been experimental. Now they're getting to the stage where they want to see returns from India. They want to see, India starting to deliver the kind of returns they expect from these other geographies.
But what is the rate of return that you're going to a LP and pitching, you're going to a limited partner and pitching your fund to take their funds? What are you seeing? Will you make 15% a year, 10% a year, 20% a year?
Actually, you know what?
I think compounded, they would like to see that something in the
north
neighborhood
of 20% net dollar IRR.
Net IRR after fees.
After the carries, after fees.
After the fees.
Carry is basically what of the gains. I'm for the audience.
But is that the same? I think the first part of the question, is that the same for all three of you?
The LP, I think all of us raised from the same set of limited partners, endowments, institutions, etc.
And they're very methodical in the way they allocate.
And how do you first find these limited partners?
With all due respect to their efforts, I think they are riding a little on their franchise relationships. So their American brands and Chinese brands have also done a lot of work.
So you're saying we don't work for our fundraising. He has to work for our fundraising. No, which is a fact.
There's enough of a track record to rely on.
Also it's a fact that without a parent, like overall thing, like how we all got started, it's
we
very
try
different.
to ride on their sort of coattails.
How do you do that?
They're talking to a certain set of people, so people are exposed to India.
Right.
So they come asking. They come and visit them.
Right.
And they say, hey, tell us who else is emerging.
Right.
So Prashanth will be kind enough to make 3 introductions and say, you should meet these Blume.
But I'm saying referrals play a huge part in this.
Absolutely.
Yeah.
It's about trust.
Yeah.
And both of you know this better than anyone else. You manage or you basically handle money. Money is more about, I would actually index trust more than returns.
See, because for a lot of them, India is something they're kind of starting like a 20, 30-year journey. That's how long these institutions think.
Because of the events around leakages in compliance and governance in India recently, the trust that all of you worked so hard to build over the last 10 years, 20 years, I'm talking about that trust which went from 0 to 80 has come down to what number now?
No, I don't know where the trust has come down. FTX, is like 10 times. You look at FTX, you look at, this doesn't happen only in India, right? I know it's happened to us, and obviously we should collectively do a lot more to make sure that we mature the ecosystem that way is to be. But if you're a global investor, FTX was 10 billion, right? Total value lost was 10 billion, not what the venture capitalist lost.
Right.
We are yet to see one, and that's one of several that have happened. So it's not and because these LPs have a global view, right? They invest in US funds, China funds, India funds. So what the questions are really, look, why is this happening? What is, what is the ecosystem doing about it?
No, that's a fair point.
Right? And so I think it's not because we are in it, of course it's something that we need to address. There's no question about that.
You're saying it's not an India problem, it's a global problem.
Absolutely not, right? Look at the data. The data shows, right? You have to keep in mind that, because we are here in our ecosystem, right? We see this huge correction, but this is a global phenomenon. Public tech stocks outside of the FANG are down between 60 and 80%. Zoom's down 90%. It's one of the greatest companies. Maybe it's up now, but it was down 90%, right? So similarly, if you look at private tech valuations in the US, they have corrected much more than they have here, right? Here, I think it's a phasing issue. So what has happened over the last 2 or 3 years is not an Indian phenomenon. Agreed. It is a global phenomenon, right? So, and these institutional investors, they invest globally. They invest in the US, which is where most of their capital is deployed. They invest in China, they invest in India. So for them, this is not an India phenomenon. I mean,
so I had just to add on to the question. So these LPs, I mean, the investors are sharp, right? As in, they made money. So my question is, are they really investing in you, the fund manager, or are they investing in India? I mean, what are they investing in? I mean, they already are sold to the India opportunity and then they're selecting a fund manager?
Yeah, it's a sequential decision, I feel. Whenever I'm faced with it and I'm on the receiving end a lot, is you don't get to the second part unless they're sold on India.
Right.
And within India, if they've already allocated, the big question is, do I need to allocate more?
Right.
Or am I, as Prashanth said, am I still experimenting with the market? I have a check with Accel, I have a check with another fund. I'm okay for now. Right. Why do I need to add Blume?
Got it.
Right? So for them, it's about until, and no pressure on Prashanth, but unless he delivers in spades, they don't need to necessarily add me.
Right.
Right? And so there's a sequencing. And then within that, also there is late stage, early stage. The guy might not like my strategy, right? And so it's not about like investing in a manager, but they have to actually relate to the strategy. Right. I know $50 million check writers who say, you guys play too early. I don't like how early you play.
And then
you guys do too much work for too little.
Yeah, so they have to believe in India first.
Right.
Yeah,
and then once you decide that, then you decide, okay, who are the best fund managers that you want to invest in that.
And then they look at the spectrum of early stage,
growth stage,
growth.
And then how do they benchmark you? As in, what do they benchmark you against?
Just too early.
So we are setting that, right? Between all of us,
right. The first 15 years.
The first 15 years, you're setting that expectation.
It's exactly around 16, 17 years since this wave began.
Right.
I think most people wrote off the pre-2005 wave.
Right.
So essentially the resets happened in 05, 06. So almost all the top 10, 15 funds that you see would have been born around then.
Right.
And then another wave in 11, another wave in 15, now another wave in 18, 20. So managers are being built that way. So the new manager will be judged on the back of, are you doing as well as the old manager?
Is there a tax arbitrage there? If your global money coming into India, do you pay lesser tax than Indian money investing in India?
Yeah. Actually, to your point, there isn't a tax arbitrage. Everybody pays the same taxes. It's only certain global sovereign funds which have a double tax treaty equivalent, so they don't have to pay the taxes. But everybody else has to pay.
So for instance, let's say we take, as PeakXV, we've had 19 IPOs, right?
Right.
Domestic market IPOs, the same whether it's a domestic AIF, whether it's us, we pay tax. There's no difference.
So the only reason they pool outside the country is because they don't want to pay the tax themselves in India. So we deduct and send the money if you're an international investor. So there's no tax filings for them in India. Right. But the tax treatment is the same.
Hi, I'm Nikhil Kamath. I'd love to know what you thought of the episode. Comment, like and subscribe, and thank you for watching.